The head of the Australian Securities Exchange has hit back at politicians who are threatening to block the planned takeover by the Singapore Stock Exchange. Robert Elstone says that in an era of globalisation, Australia's national interests will not be served by sending a message to the world that we're closed for business. Andrew Robertson reports.
The message coming from Canberra is that the $8.4 billion merger between the ASX and the Singapore Exchange will struggle to be approved. The news doesn't impress the man who's orchestrated the deal.
ASX's participation in regional or global consolidation is a mandatory subject. It's not an elective subject.
The global securities trading industry is involved in a wave of consolidation, with mergers involving the New York and German stock exchanges and the London and Toronto exchanges also currently on the drawing board. Robert Elstone's concern is not just that the ASX will be left behind if it doesn't get bigger, but that Australia as a whole will also fall behind.
The Australian national interest is not going to be well served by signalling that we're not open for business, we're not open for foreign inflow, we're not open for a true engagement with Asia.
Robert Elstone believes the sovereignty issues around the Australian Securities Exchange need to be separated from the debate about ownership.
The reality is that foreigners own ASX today. No one jumps up and down about that fact whatsoever. There is nothing stopping foreigners owning 100% of ASX today.
The Singapore Exchange has now agreed to have equal representation of Australian and Singaporean directors on the board of the merged company, but even with that concession, there are some who believe it's not a good deal for ASX shareholders.
I don't quite understand why ASX, with a very well-established derivatives business, which is where Singapore also lacks, and also trading fees, which are already down, not quite down to US levels, but down, would want to join forces with a stock exchange that has very high trading fees and which are a threat, and also a less established derivatives business.
The debate about the takeover overshadowed the ASX's first half earnings result, where net profit rose 2% to $172 million. The interim dividend was up 1% to 90.2 cents a share.
The number was right on what I was expecting. Listings income was up, largely due to price increases, which occurred about 12 months ago. Cash market income was a little bit weaker. That was also due to pricing changes. They cut prices recently in anticipation of competition.
Also reporting today was another company involved in a takeover in the form of AMP. Full-year net profit was up 5% to $775 million, with the dividend maintained at 30 cents per share. However, underlying earnings were down, which, according to BBY banking and insurance analyst Brett de Mesure, highlights problems with revenue growth and costs.
As we measure it, revenue growth was 2% from the 2009 to 2010 year, and expense growth was 6%. And the low revenue growth was due to margin contraction and relatively weak cash inflows.
AMP is an investor in the Australian Securities Exchange, but Chief Executive Craig Dunn refused to be drawn on the merger with the Singapore Exchange.
In the end, that's a matter for the government and the Australian Parliament to determine.
As AMP waits for shareholder approval for its $14 billion takeover of AXA Asia Pacific, it's invited 2 AXA directors onto its board, one of which is AXA chairman Rick Allett.